All right, I'm Dustin Tibbetts, financial advisor with Jazz Wealth Managers, and today we're talking about buying losing positions in your IRA to generate extra income. How's that for clickbait, huh? All right, here's the thing. Maybe you're somebody that says, I've seen the markets go up for the last 9 years. I understand the 200% rally that we've seen, and I'm a little worried that the markets may pull back. You may also be somebody that's close to retirement and says, this is a great run. I got my money back from 2008, and now I'm getting close to retirement. I can't afford any sort of meltdown. North Korea, tax issues, whatever Trump's gonna do, you may think that something scary is about to happen and you just can't afford even a 20% pullback. So what we're talking about today is actually buying losing positions that will go down as the market goes up, but we're specifically going to talk about how to generate income from that. So here we go. Chances are, I don't know what this is, but chances are you have some sort of market participating products in your portfolio, okay? And I'm just going to say it's the S&P 500. Most people have some product in their portfolio that's participating with the movement of the S&P 500. Now, over the last 8 years, you've watched it grow. It's done really, really well. Now, if you don't have any way to protect that, if you're not able to go into your account and say, I'd like to take some money off the table, I'd like to reduce my risk, well then if the markets fall, you're pretty much just stuck holding a now declining S&P 500. Well, there's ways around that. You can buy products that actually go down as the markets go up. And by no means am I talking about inverse ETFs, okay? So if you're watching this and you think I'm about to start talking about inverse ETFs, I will never talk about that. The only reason you would look at inverse ETFs are for day trading, or if you were some wild trader that liked to play day by day. But other than that, you will not be looking at inverse ETFs. The cost is too high, the drag is too high, if you know what I'm talking about. So we need other alternatives. What if you came to me and said, look, I've got $500,000, protect what I have, okay? What we can do is we can look at buying negative positions. Now, I'm not talking about, of course, the inverse ETFs, and I'm not talking about buying something that we hope loses. I'm talking about positions that naturally move in the opposite direction of the markets. Okay? Imagine for a minute, here, I'll just do, this is the United States, my poor version of the United States, right? And imagine if for a moment you could buy a house in Miami, okay? And then you also could buy a house in Montana. And you did that because for every dollar that the Miami house went up, the Montana home went down. Now this is of course not how it works in real life, but what if you could do that? What if you knew that if you bought a house here and you bought a house here, that they would move perfectly like this over time? What would you do? The answer is you would buy 1,000 homes here and you'd buy 1,000 homes here, and then you'd rent them out to people because you're gonna get the rental money here, you're gonna get the rental money here, and you are never ever going to make any money off the appreciation in the value of the properties. Unless you had like perfect timing and you were able to sell these on the way up and then sell those when things turned around. But we're not playing that game today. So imagine for a moment if you could do that. You cannot do that, or it's at least very hard to predict. But in the stock market, we can do this. We see this every day. Not only is it predictable, it's quantifiable, meaning we can go up, down, back, forward, analyze the living death out of it moment by moment and make sure we're buying a product that moves in the opposite direction of the market. So let me give you an example. Let's say your first position here is the S&P 500, and this is in your portfolio. And we're going to say S&P 500. And then you looked for another position that would move in the opposite direction. Okay, so this is what we're trying to build in your portfolio. What position would that be? Well, at the moment, you could look at something like gold, okay? So maybe you add gold to your portfolio. And I'm not saying rush out and do this. Give me a second to make an example because this is not perfect. I'm going to explain to you in a second. So if you were to buy 1 for 1, meaning you bought 1 S&P 500 and 1 gold. I'm using 1 to keep it simple. You wouldn't buy just 1. 1 doesn't mean anything. We're talking shares or ETFs here, so we're just using 1 to 1 to show a ratio. If you bought 1 S&P 500 and you bought 1 gold, What if they move like this? And they do. They move in opposite directions. Well, what that means is you're never going to make any money off of this gaining value or this gaining value, because one's always going to offset the other. But what you can do is now you can say, I'm protected. Okay? If the markets fall, gold should go up. If the markets keep rallying, gold should go down. I'm protecting the money that I have in my account. Remember, that's what you came to me and asked for. In the meantime, we can rent this and get some money for that, and we can rent gold. Believe it or not, you can rent out gold to other people. They'll pay you to just rent it from you. They don't want to own it, they just want to rent it. Okay? Here's the problem. It doesn't work like this. One for one does not work. Right now, in the real world, this is how it works. If you were to go test me on this and look at this portfolio, if you built this and you tested it, you would find that for every one S&P 500 you bought, you'd actually have to buy 3 gold. Okay, the ratio is 1 to 3. All that means is that as this rallies, this drops about 1/3 of what this rallies. And that's fact. That's not my opinion. That's exactly what happens right now at this very, very moment. So now you've built a completely hedged portfolio by buying 1 of this and 3 of that. So if the markets keep going higher, this will drop at the exact same rate. If the markets start going lower, this will rally at the exact same rate, even though you have 3 of them. Okay, that'll change a little bit, but basically that's what it is. Why would you do that? Why on earth would you buy something or buy a package that is not going to move in your favor at any point? The value of the two will always offset each other. It's the rental income. It's the real estate that I just explained. Buying the house in Miami, buying the house in Montana. If you're trying to protect your money, then your goal is not to make money off of this. You've made your money on the S&P. You're close to retirement, and now we need to protect. So what are we going to do to make sure you keep getting income? We're going to take the S&P 500. We're going to take our 1 here, and we're going to rent it out and get some money for you for that, okay? Then we're going to take the 3 gold that you have, and we're going to rent that out, okay? So you're going to collect rent here. You're going to collect rent here. You get to keep it. But the value of these properties are going to just pull against each other for the life of the portfolio. Now, you don't have to do this one time. You can say, all right, well, that's a good example, but I've got a lot of money. I've been saving. I'm close to retirement. Maybe you have $1 million, 500,000, I don't know, whatever you have. We can build a portfolio like this to really diversify your holdings. We can put 6 positions in there, and we can make it look something like this. All the positive positions move in this sort of fashion. As the market goes up, some are strong and some kind of lag behind. And then we can come over here and say, let's offset it with something like this. This is just obviously an example, but it would look something like that. This portfolio as a whole is even more diversified, meaning we're not relying on one position and one position to work for us. We've got a bunch of them. So in the event that something really dramatic happens, we've got a bunch of positions we can work with rather than just 2. But all along the way, we're going to go rent this, we're going to rent this, we're going to rent this, we're going to rent this. You get what I'm saying? It sounds repetitive, but you're going to collect that rent, okay? So this is something that the ultra wealthy do on a daily basis. If you're working at one of the big firms and you have a big account balance, they'll do this for you. You have to explain to them that this is exactly what you want, but they'll do it for you because it protects. You can't buy dividend stocks right now. The dividend doesn't offset the risk that you're taking. So if you want income in dividend stocks, you're just not going to get it. If you want to buy bonds, you're not getting the yields over there. There's no real good income in bonds right now. They've really been an underperformer. And you can't buy stocks because you want to protect your money. So this is the alternative. This is what we want to do. We're going to call this a balanced rent. I don't know. This is a balanced rental, okay? That's what I call it. Now, if you want more information on what it means to rent your IRA, we've basically just covered it, but I go into great detail on our website, jazzwealth.com. Just scroll down a little bit there. You'll see 3 videos that explain renting for growth, renting for income, like we just talked about, and how you can, use this product. Now, it's not suitable for everybody. If you're just getting started, then you want to build a basket of products and you hope the markets drop so that you can buy more at a discount, okay? If you have something that you want to protect, if you have an IRA that you're saying, okay, I buy into this, I get what he's saying, Just go to jazzwealth.com. You can schedule a call with me. I'll help you get everything set up. We never charge commissions. I don't charge you to do this, so I don't get any sales fees or things for picking out gold and S&P and stuff. And you always get to keep your account in your name. I never touch your account. I'll just manage it for you. I hope to talk to you soon.